This is Sharon Garvin of Wayne State College, and this is my screencast for Chapter 21 of the Accounting 2 online course. I'm going to do two example problems for you here quick. One is the high-low method, and the other is the contribution margin income statement. Under the high-low method, we're taking a look at a mixed cost. In this case, it's maintenance hours, and this particular cost has some fixed costs inside of it and some variable costs inside of it. So if we're predicting for the future, we have to have an estimate of what we think those fixed costs are and what we think the variable cost per some cost driver unit of activity is in order to be able to predict what that cost is going to be as a manager. So what we do is generally look at a scatter graph and maybe visually plot a line down the points that we might plot here. Machine hours would be the independent variable X if you were doing high school algebra. The maintenance costs kind of depend on the hours, so they would be the Y if you were going to graph like you did in high school algebra class, what your maintenance costs were. And we would visually lay a line kind of down the middle of the points. Whatever the slope of the line is, that would be the variable cost per machine hour. And whatever the y-intercept would be the fixed cost for a relevant range of activity. So using this information from the controller, that is the top accountant in the organization, we've taken a look and seen what our mixed costs in maintenance have been for the last 6 months. And we've looked up the corresponding amount of machine hour usage during that period of time. We're going to try to see if we can use machine hours to predict what maintenance costs would be. That way, if we kind of know how many machine hours we're going to be using in an upcoming month, we can pretty much predict what our maintenance costs are going to be. In higher level classes, after you've taken a statistics class, we'll use linear regression on an Excel spreadsheet to be able to do this. The scatter graph method is explained in your book, not really used a whole lot, although some people do their scatter graphs on the computer. It's a lot easier than drawing by hand. But this is just accounting too. So we're showing you the quick and dirty method called the high-low method. We're going to look at the points we have, pick out the one that had the highest level of activity and its corresponding cost, pick out the lowest level activity and its corresponding cost. From an algebra perspective, assume that the line we would be plotting would go only through those points. Whatever the slope of the line is will be the variable cost per machine hour. Whatever the y-intercept is would be the fixed cost for this particular mixed cost. So first we're going to develop an equation for predicting what the future maintenance cost is. That will include a fixed cost component and at least a variable cost rate per unit of activity. So I look here through the different activity levels I have. I notice that the highest level activity is the month of May because it had 800 machine hours. And I notice that the lowest level activity would be February, which only had 300 machine hours. This is the column I use to determine the high and low method amounts. I don't really look at the dollar amounts. In this situation, it does so happen that the May figure has the highest dollar figure, and the February situation here has the lowest dollar figure. That isn't always the case. So the deciding criteria is activity, the highest level activity and lowest level activity with their corresponding costs. From an algebra perspective, if we're going to plot these points, where again the x would be 300, the independent variable, the y would be 2400, the dependent variable, and then the other point would be independent variable of x of 800, dependent variable of y 4900, and put a line through these 2 points and determine the slope to get our variable cost per unit. This is how the math would work. Recall from high school algebra class that we would determine the slope of the line as rise over run. That is the change in the y's divided by the change in the x's. So in other words, in more layman terms, the variable rate would be the change in cost divided by the change in activity. So we're trying to find out a dollar amount per hour. So the dollar amounts go up here in the numerator, the machine hours go in the denominator. I take the difference between the high and low activity level dollar amounts divided by the high and low level activity levels, and that would crunch out to be $5. I always have my students in class label that's $5 per machine hour. For prediction purposes, we would assume that in the future, whenever we're going to run our machines for 1 hour, there would be $5 worth of variable cost incurred by the company. Now on to the fixed costs. The fixed cost would be the y-intercept if you're thinking in terms of your old high school algebra class. In more layman terms, we basically say, okay, the total cost for this particular type of cost, maintenance, would be equal to the fixed cost, which we don't know what that is, plus the variable cost. So since the line in algebra terms is running through these 2 points, you can use the high point or you can use the low point. It really doesn't matter. I generally tell my students use the high point, so we're all doing it the same way. So I look at my high point of activity, that is the month of May in which I worked 800 machine hours and incurred $4,900 worth of cost, and I put the information into this formula. So the total cost of the high level activity is $4,900. The fixed cost is X because I don't know what that is. And the variable cost would be this $5 per machine hour rate that I just calculated up here times the number of machine hours I incurred in the high month of activity, 800. So if you solve for X, you're going to get 900. 4,900 is X plus 4,000, so X must be 900. So the prediction formula you would have for upcoming months would be an assumption that the fixed cost portion of maintenance cost is $900 per month. The variable cost portion would be $5 times the number of machine hours we expect to incur in that future period. So on an exam, I might ask you to come up with a formula and use it to predict what a future cost would be. So assuming July is a future period for this company and we're anticipating working 700 machine hours during that period, could you as a manager predict what the maintenance cost would be? We need to use our prediction formula here and plug in the 700 machine hours we expect to incur to be able to make that prediction. Therefore, on the exam, the predicted maintenance cost would be the 900 fixed cost of this mixed cost item plus the $5 variable cost per machine hour times the 700 expected machine hours. It's 3,500 plus 900 is 4,400. So the answer is the predicted maintenance cost for July would be 4,400. Again, this also works if you use the low point of activity to come up with the fixed cost. You can use either high point or low point. I just used the high point here so everybody was doing the same thing. This ends at least the part of the screencast related to the high-low method example. The other thing I want to cover is an example of a contribution margin income statement. This is different from the traditional format income statement that's required under generally accepted accounting principles for reporting to stockholders, bankers, potential investors, and other creditors. This income statement is in a format specifically prepared to help managers make better decisions. We can do contribution margin income statements per product line, per geographic area, per division, all different segments of the business to try to determine which ones are our stronger performers, which ones are our weaker performers, and what strategy adjustments we're going to make for those items that are weaker. So, it's a really important concept and something you need to learn to help you make better business decisions in your future careers. So here we have the basic format for the contribution margin income statement. Instead of taking sales minus product costs and taking a subtotal called gross profit or gross margin or gross profit margin, subtracting out our period expenses and getting income, under the contribution margin approach, we take sales minus anything that's variable. I don't care if it's a variable product cost or variable expense, period expense, doesn't matter to me. Anything that's variable gets subtracted out here in the top part of the income statement. The subtotal is called contribution margin. From the contribution margin, I subtract out anything that's fixed. Don't care if it's a product cost, I don't care if it's a period cost, anything that's fixed gets subtracted out in this part of the contribution margin income statement, and then I have my bottom line profit. So we're basically subtracting things out on the income statement in a little bit different order to get this new important subtotal called contribution margin. If I were going to do an Excel spreadsheet to create some power in it, I would have input cells for the 4 basic things I need to be able to calculate this income statement. That is the selling price per unit, the variable cost per unit, the total fixed cost, and the number of units sold. And in my output cells, I would have the contribution margin income statement. I would teach the computer how to do this income statement so I could more easily play what if in different strategy decisions I might make to help improve the profitability of this business segment. So again, in Excel, to tell them Excel you wanted to do some mathematical computations, you type in the equal sign first, and I want to take the selling price per unit, which in this case is D33. I don't know if you can see that side of the screen here, but we're on row 33 here, so this is D33. And I need to multiply that by the selling number of units sold, which is in my case D36. So I'm taking the 34 times the 4,200, and it's giving me sales. Then I want to subtract out variable costs. So I'm going to put a negative sign here to make it a negative number. Later on I can add to get my income statement subtotals and totals. So I'm going to take the variable cost per unit, which in my spreadsheet is D34. And I want to multiply again by the number of units sold, which is D36. Yes. And that would be the variable cost associated with my computation here. Probably underline this to indicate that I'm doing a mathematical computation here. And I'm basically taking what's in cell F40 and adding it to what's in cell F41. So it puts those two together and gives me a nice subtotal, which is called contribution margin. Remember what contribution margin is? It's the amount that the particular product line, geographic area, department, store, whatever the subunit is of the business, it's how much that subunit is contributing toward the payment of fixed costs, which are going to be there anyway, and thereafter generate a profit for the company. So down here I need the fixed cost, so I tell the computer run up and get the fixed cost number. I need to subtract it out, so I'm going to put a minus sign here. And the fixed cost is up in cell D35 on my spreadsheet. So I'm going to subtract that there. Put an underline under this to tell the person looking at my statement that a mathematical computation is taking place. And here's the bottom line figure. So in my case it's F42 plus F43, and it tells me what the operating profit is. Again, if you're looking at subunits and you find your subunit has a positive contribution margin, you should keep that subunit. If you get rid of the subunit, you would be giving up this contribution margin and not have this dollar amount available to you to pay those fixed costs, which are going to be incurred whether or not you have this segment. So, you want this number to be positive. If it's positive, you keep that subunit of the business. If it's negative, you think about getting rid of that subunit of the business. It's not even paying for its variable costs and expenses, let alone contributing anything toward the payment of fixed costs, which are going to happen anyway, let alone contribute to the profitability of the business. So that's important. What happens here is, from a management standpoint, when you're going to do your other case, you'll be able to play what if here. What happens if competition gets fierce and we have to drop our selling price from 34 to, let's say, 32? So we change the input cell and watch down here at the income statement and notice how the numbers will change when I hit the enter key. Right now we had a contribution margin of over 50,000 and an operating profit of 17. Once I change the selling price, it's only 42,000 and 9,000. So I can do what we call sensitivity analysis, play around a little bit with my input cells and see how it affects the profitability of that particular business segment. If variable costs go up, they were $22, but I increased some advertising per unit or pay a sales commission to my salespeople to sell these items. If I give them $1 a piece, that means the variable cost per unit, instead of being 22, might be 23. So I'll change that. Again, watch the numbers down here. Instead of 42 and 9, making that change gets me down below 38,000 and below 5,000 down here. If we anticipate increased demand for our units, and maybe we think the sales of units are going to go up to 4,500, I could change that input cell, and instead of about 38 and about 5,000 down here, I'd go up to a little over 40,000 and 7,500 down here. So spreadsheets are a great way of playing what if, and you as a manager in this class, we want you to kind of play what if and think about different strategies you might employ for your business and how that would affect the profitability of the business. Again, contribution margin is something important the managers look at. If it's a positive amount, we keep that subunit. If there's a negative amount, we get rid of that subunit. It's a very good indicator as to whether or not the particular product line, geographic area, whatever the subunit is a profitable one as far as the company is concerned, and helping contribute toward the payment of fixed costs that are going to be there anyway, and above and beyond that, helping the company generate a higher overall profit. This is the end of my Chapter 21 screencast.